Welcome to the Deep Dive, the show where we extract the most important nuggets of knowledge from your sources. Today, our focus is squarely on making smart investment decisions, especially when you're facing a project just surrounded by this, well, mountain of what-ifs. We're exploring some powerful methods to understand and, maybe more critically, manage that uncertainty in project profitability.
Yeah, it's a big challenge, isn't it? I mean, in any economic analysis, you're fundamentally working with estimates, always.
Exactly. Estimates for costs, for revenues, for performance.
And right there, with estimates comes uncertainty. It's inherent.
So the big question is, how do we move beyond just, crossing our fingers and hoping for the best? How do we actually get a handle on those unknowns?
Well, that's what's so interesting about the systematic approaches we're looking at today. They let us really map out the whole landscape of possibilities for an investment. This deep dive is all about giving you the tools, tools that turn those vague what-if questions into genuinely actionable insights.
Actionable insights, I like that.
Yeah, methods that help predict the impacts of changes and even start to quantify the probability of success. It really empowers much, much better decision-making.
Absolutely. So get ready, because we're going on a journey here. We'll uncover how to quantify the impact of specific variables.
See how they play out visually.
Visualize their effects clearly, yeah. And then, crucially, get into understanding the probability of actually hitting your financial targets.
It's a real shift in perspective, moving beyond just single numbers.
Okay, let's kick things off with our first essential tool, sensitivity analysis. You can almost think of it as your project's what-if machine.
That's a good way to put it.
Imagine you're about to greenlight a pretty significant investment, right? And you're thinking, okay, what if our capital expenditure, our CapEx, ends up being, say, 15% higher than we budgeted? Is this whole thing still viable?
Or maybe, what if the market price for our main raw material suddenly drops by 20%?
Yeah, how badly would that hit our internal rate of return, our TIR? Sensitivity analysis is built to give you clear answers to exactly those kinds of questions.
And it's not just the financial side either. It extends right into critical technical questions.
Like what?
Well, what if we tweak our reactor design and the reaction yield bumps up by 10%? What does that do to our net present value, our VPL?
Okay, so connecting the technical specs to the financial outcome.
Precisely. Sensitivity analysis directly shows how changes in those key assumptions, whether they're economic or technical, ripple through to affect the project's profitability. And, our sources are really emphatic about this. Any robust technical economic analysis must include a sensitivity analysis. It's just fundamental.
Right. And its real power, maybe, isn't just answering those one-off what-ifs.
No, it's more than that.
It's about identifying which variables you need to watch like a hawk.
Yeah.
Because they have the biggest impact, the biggest ripple effect.
That's the key insight, yeah. Prioritization.
Okay, let's make this more concrete. We've got an example from the sources. A hypothetical project, right? It has a base net present value, VPL, which, just quickly for everyone, is basically the value added to your wealth by doing the project, discounted to today's money of R$61.3 million.
Yeah.
And that's R as in Brazilian reais.
Okay.
And the key variables in the mix are CapEx at R$100 million, OPEX operating expenses at R$60 million, a plant scale of 25,000 tons per year.
Oh, cotton. Yeah, 1,000 tons.
2 ton, right. And a product price of $2,400 per ton.
Got it. A typical set of inputs.
So what we're exploring is how that R$61.3 million VPL changes when these inputs wiggle by plus or minus 10%, 20%, maybe even 30%.
And this is where visuals become incredibly helpful. You need to see the impact quickly. Our sources highlight two main types of graphs for this: the spider graph and the tornado graph.
Okay, let's dig into the spider graph first. What's that showing us?
The spider graph gives you a really quantitative picture. You can literally read the exact VPL value for each specific percentage change right off the chart lines.
And all the lines start from the same place.
Exactly. They all intersect at the center point, which is your base case 0% variation and that R$61.3 million VPL we mentioned.
Okay. So looking at the spider graph for this example project, what jumps out?
Well, it's immediately clear that plant scale has the most dramatic impact on the VPL. By far.
Really? How so?
If the scale drops from the base 25 kT down to, say, 18 kT per year, that's about a 28% drop, the VPL actually goes negative. The project becomes non-viable.
Wow. Okay. That's a huge swing.
It is. And on the flip side, if the plant scale increases by 30% up to 33 kT per year, the VPL more than doubles.
So scale is king here.
It certainly seems to be. And interestingly, the line for scale isn't perfectly straight.
Why is that?
It reflects how scale impacts CapEx, often following something called the rule of 6/10, basically. Costs don't always scale linearly with capacity in engineering projects. A bit of a technical detail, but it shows up visually.
That's a really critical point. So
Yeah.
if you're the investor looking at this and you see plant scale is the most sensitive thing, where should you focus your due diligence, your verification efforts?
That's exactly the takeaway. Your focus should be intense on market demand projections. Can you actually sell that volume?
Right.
And on the technology's scalability, can you reliably achieve that production rate? Are there regulatory hurdles tied to that scale? That's where your deep dive needs to happen.
And does this also mean for this specific project, maybe we worry a bit less about CapEx or OpEx variations?
Relatively speaking, yes. The analysis for this example shows that even if CapEx or OpEx jump up by 30%,
Which is quite a lot.
which is significant, yeah, the VPL still stays positive and actually above our $30 million.
Okay.
So while those costs are obviously important, they're less volatile drivers of profitability for this project compared to getting the scale right, or indeed the product price. They become, let's say, a lower priority for risk mitigation efforts than scale or price fluctuations.
Got it. Now, what about the other visual tool you mentioned, the tornado graph? The spider graph gave us precise numbers,
Right.
but sometimes you just need that instant, oh, here are my biggest worries snapshot. How does the tornado graph deliver that?
Think of the tornado graph as like your rapid response dashboard for risk. It's built for quick, qualitative impact assessment. So instead of multiple lines showing all sorts of percentage shifts, you typically get horizontal bars.
Yep.
And these usually represent just one predefined range, like plus or minus 30% variation for all variables.
So just one scenario shown visually.
Sort of, yeah, one range of impact. But the power is in how it's arranged. The length of each bar immediately shows you which variable has the biggest swing, the most weight, and they stack them with the most impactful one right at the top.
Creating that tornado shape.
Exactly. Widest at the top, tapering down. It's an immediate, almost visceral prioritization of your risk factors. It tells you instantly where to focus your risk management efforts first.
Okay, that makes sense. Quick visual hierarchy of risks. So sensitivity analysis helps us identify the big movers. But there's another critical piece of the puzzle. Figuring out the minimum selling price.
Right.
As an investor, you're definitely going to ask, what's the absolute rock bottom price I can sell this stuff for and still just break even, keep the lights on, essentially?
That's exactly what the minimum selling price tells you. It's the price point where the project's VPL calculation hits precisely zero.
Okay, the break-even point in VPL terms.
Yep. And knowing that is crucial for evaluating how competitive your process is against, current market prices, or maybe against alternative ways of making the same product. It sets a kind of strategic floor for your pricing decisions.
And the cool thing is, it sounds like calculating this isn't some super complex thing.
Not at all, especially with standard tools. Our sources point out how straightforward it is using something like Excel.
Oh, yeah.
There's a function called goal seek, usually under the data tab, then what if analysis. You basically just tell Excel, set my VPL calculation cell to a value of 0 by changing the value in my product selling price cell. And it does the math for you.
That's pretty neat. So for our example project, did they run that?
They did. And the minimum selling price came out to our $1,668 per ton.
Compared to the base case assumption of our $2,400 per ton.
Exactly. So there's some cushion there in the base case.
Now, does that minimum price change much if the plant scale varies? You said scale was super sensitive earlier.
That's a great follow-up question. And the analysis showed something interesting. Even if the plant was about 25% smaller than the base case, the process still remained competitive. Its minimum selling price stayed below that market reference of our $2,400.
So it suggests a certain robustness, maybe, even if you can't hit the optimal scale.
It does suggest some flexibility, yeah, an ability to compete even at somewhat smaller production volumes, which could be strategically valuable.
Right, so we've looked at wiggling individual variables, finding break-even points, but real life is messier, right?
Yeah.
Things tend to happen together.
Definitely. You rarely see just one thing change in isolation.
So how do we bundle these what-ifs into more plausible packages? This brings us to scenario analysis, doesn't it? Where you combine shifts to paint broader pictures.
Exactly. You create coherent storylines, a realistic one, often your base case, an optimistic one, and a pessimistic one.
And our reference material walked through this.
It did, providing a really clear example of how looking at these combined scenarios helps you assess market positioning. Remember, our base case minimum selling price was our $1,668 per ton.
Got it.
Now, consider pessimistic scenario. CapEx goes up 20% to 2024 Ms, OpEx also up 20% to 24 MNs, and the plant scale drops 20% to 20 CODIR. This is a perfect storm, basically.
Ouch. What does that do to the minimum price?
It skyrockets, jumps all the way up to $2,622 per ton.
Whoa. And the market price was $2,400.
Right. So in that nasty combination of events, the project suddenly becomes uncompetitive. That scenario clearly flags a major risk profile.
Okay, that's sobering. What about the flip side, the optimistic view?
In the optimistic scenario, CapEx drops 20% to R80 orbs, OpEx also drops 20% to R16 levers, and scale increases 20% to 30 CODIR. Everything goes right.
So the dream scenario.
Pretty much. And the minimum selling price plummets to just $1,072 per ton.
Wow, highly competitive then.
Absolutely. So plotting out these scenarios really shows the potential range of outcomes and the strategic implications for your investment's market fit. It's a much more holistic view than just tweaking one variable at a time.
Okay, this is making a lot of sense. We've explored the what-ifs with sensitivity, we've nailed down break-even points and looked at scenarios. But here's the thing. In the real world, as an investor, you don't just want to know if something bad could happen.
You want to know how likely it is.
Exactly. How probable is it that my VPL is actually going to end up positive
Or
above some target I have? We need probabilities, not just possibilities.
And this is precisely where the next level of analysis comes in. Investment risk analysis, and specifically the workhorse technique known as Monte Carlo simulation.
Monte Carlo. Sounds fancy.
It sounds more complex than the core idea is. It's all about moving from what could happen to what's the probability of different outcomes. It adds this whole new, incredibly powerful dimension for investors making decisions.
Okay, so how does it work? The sources laid out some steps, right?
Right? It did. It's a pretty clear process, actually. First, you identify your key risk variables. Usually, these are the ones that sensitivity analysis flagged as being most impactful.
Makes sense. Start with the big hitters.
Second, and this is really crucial, you assign probability distributions to these variables. You have to describe how you think they might vary.
Distributions, like statistical distribution.
Exactly. So, for example, if you have good historical data, like past prices for a commodity, you might use a normal distribution, the classic bell curve, because you know the average and how much it typically varies.
Okay. What if you don't have historical data?
Then you might use something like a triangular distribution. Here, you just estimate 3 points based on your judgment. A minimum possible value, a maximum possible value, and the single most probable value.
So using expert judgment to define the range's likelihood.
Precisely. Or if something is genuinely random within a range, you could even use a uniform distribution where any value between the min and max is equally likely.
Got it. So you define how each variable might behave probabilistically. What's next?
Third, the system simulates. This is where the Monte Carlo part comes in. It randomly draws thousands, literally often 5,000 or 10,000 times a value for each of your risky variables, respecting the probability distributions you just defined.
So it generates thousands of possible future scenarios based on random draws.
That's exactly it. Thousands of combinations of inputs. Fourth, it calculates. For each one of those thousands of scenarios, it plugs the randomly drawn input values back into your main technical economic model, usually your project spreadsheet, and calculates the resulting VPL and TIR for that specific scenario.
Whoa. Okay, so you end up with thousands of different VPL and TIR results.
Thousands. And finally, fifth, you analyze that huge pile of results. You create a frequency distribution graph, often looking like a bell curve again, showing how often different VPL or TIR values occurred in the simulation.
And from that distribution,
you can directly calculate the probability. What's the probability your VPL will be greater than 0? What's the probability your TIR will exceed your hurdle rate of, say, 15%? The simulation results give you those percentages.
that is powerful, turning uncertainty into a calculated probability.
It really is. And while there's specialized software out there like Crystal Ball that does this,
Yeah.
our sources actually show it can even be programmed using standard Excel macros. So it's potentially more accessible than people might think.
Okay, let's ground this with another example. The sources mentioned an ethanol plant project.
Yes, a different case study. This one had a base VPL estimate of 87 million USD and a base TIR of 18.5%. Pretty good numbers on the surface.
Looks good, yeah. But the big question for you, the investor, is, given the unavoidable uncertainties, particularly in the initial cost, CapEx, and future ethanol prices, What's the actual probability that the VPL will end up positive? And what's the probability that TIR will clear our minimum acceptable return, maybe 15%?
Right. Moving beyond the single point estimate to the probability. So for this ethanol plant, we applied those Monte Carlo steps we just walked through.
Okay, break it down for us.
First, identify risk variables. They focused on CapEx and the ethanol price as the main uncertainties. Second, assign distributions. Now, for CapEx, crucially, this was based on a Class 5 cost estimate.
Class 5, what does that mean?
That means it's a very early stage estimate, like conceptual level. It inherently has a very wide margin of error, maybe manager 20% to plus 50%, or even wider, highly uncertain.
Ah, okay, so lots of potential variation.
Exactly. So because there wasn't good historical data for this specific project's CapEx, they used a triangular distribution. They defined a minimum value, like 75% of the base estimate, a maximum, maybe 150% of base, and the most probable, the base estimate itself. It reflects that Class 5 uncertainty range.
Makes sense. And for the ethanol price?
There, they did have historical data, actual market prices from CEP-USP over 2021-2023, so they could calculate the historical average and the typical variation, standard deviation. That allowed them to use a normal distribution, the bell curve.
Okay, distributions assigned, then the simulation.
Yep. Third and fourth, simulate and calculate. They set up a simple Excel macro. It ran 5,000 times. In each run, it randomly drew a CapEx value from its triangular distribution and an ethanol price from its normal distribution.
Using random numbers key to those shapes.
Precisely. And it plugged that pair of values into the project's cash flow model to calculate the resulting VPL and TIR for that single run. Repeat 5,000 times.
Generating this huge data set of potential outcomes.
A huge data set, yeah. And fifth, analyze. They took those 5,000 VPL results and 5,000 TIR results, built frequency distribution graphs, and then calculated the probabilities we were after.
Okay, the moment of truth. After all that simulation, all that number crunching, what did it tell the investor about this ethanol plant? Did it change the picture from that initial VPL of 87 million?
It gave them much, much richer information. The Monte Carlo analysis revealed that the probability of the VPL being greater than 0 was actually a very reassuring 98%.
Oh, wow. Okay, so very likely to be profitable.
Very likely, yes. And the probability of the TIR being greater than their target of 15% was 85%.
Still pretty high.
Still quite strong. So think about the difference. Instead of just having that single static estimate VPL 87 million, TIR 18.5%, which sounds precise but ignores the risk.
Right. It hides the uncertainty.
It hides the uncertainty. Now, you have a quantified picture of the project's chances. You know there's a 98% chance of making money, an 85% chance of hitting your return target. It's a much clearer, more honest assessment of the risk.
It moves you from that single number, which feels deceptively solid,
Exactly. Misleadingly precise sometimes.
to a much more robust probability distribution.
Yeah.
It feels like it drastically improves your ability to make an informed call, knowing the odds.
That's the core value. It quantifies the impact of those risks you identify and gives you this nuanced, confident basis for your decision.
So, wrapping things up today, we've really taken an in-depth look at some incredibly powerful tools for navigating that inherent uncertainty in any investment.
We covered a lot of ground.
We started with sensitivity analysis, that what-if machine that answers your key questions and helps prioritize which variables need the most attention.
Identifying the critical levers.
Then we moved on to finding break-even points, like the minimum selling price, and using scenario analysis to paint those bigger pictures, pessimistic, optimistic.
Seeing the range of plausible combined outcomes.
And finally, we explored Monte Carlo simulation, the tool that takes it to the next level by giving you the actual probabilities of success for your investment goals.
And it's so important to remember these aren't just, academic exercises tucked away in a report.
They're practical.
They are vital methodologies. They transform that static economic analysis spreadsheet into a dynamic engine for decision making. They help you understand not just what might happen, but crucially, how likely different outcomes are. It gives you that comprehensive, probability-driven view of your investment's real risk profile. You're moving from maybe hopeful guessing towards truly informed strategy.
So thinking about this for you, our listener,
Yeah.
as you evaluate your next big decision, maybe your next investment opportunity,
Yeah.
imagine you get presented with a project. And it looks great on paper, right? It's got this nice single VPL number attached to it,
The classic presentation.
the classic pitch. But this deep dive shows you how to push back, how to ask for more. How might you use these insights we've discussed Thinking about identifying the most impactful variables, understanding the break-even points, maybe even demanding to see the probability of achieving the target return. How could that help you challenge the assumptions and really strengthen your own investment strategy?
It's about asking tougher, smarter questions based on these techniques.
Think about the confidence that comes with that, when you're not just sitting there hoping for the best case,
But truly understanding the range of
and
possibilities.
their likelihood. That feels like real power in decision-making, doesn't it?
It absolutely does. Knowledge is power, and in this case, probability is power too.